Hey, this is Economy Breakdown, and we need to talk about what's actually happening right now in the real estate market. Trump just announced a $200 billion plan to flood the housing market with cheap money. And if history teaches us anything, this won't make homes more affordable. It'll do the exact opposite. Because while everyone's celebrating falling mortgage rates, there's a darker pattern unfolding that most people aren't seeing. I've been deep in the trenches of this market since 2008, and I'm currently liquidating my entire real estate portfolio. Not because I'm predicting a crash, but because the fundamentals have shifted in ways that most investors are completely ignoring. Before we dive in, do me a favor. If this kind of breakdown helps you make smarter decisions, go ahead and smash that like button for Economy Breakdown. It's completely free, costs you nothing, and helps more people find this content. Appreciate you. So here's what just went down. On January 8th, the administration announced plans to pump $200 billion into mortgage-backed securities. Now, if you're not familiar with how this works, let me break it down really simply. When you walk into a bank and get approved for a home loan, that bank doesn't actually hold on to your mortgage forever. Instead, they package your loan with thousands of others and sell it as a financial product called a mortgage-backed security. Under normal circumstances, these packages get purchased by pension funds, insurance companies, hedge funds, basically big institutional players looking for steady, predictable returns. But when the government steps in with a massive $200 billion buy order, it drives up the price of these securities. And when prices go up, yields drop. When yields drop, mortgage rates fall. Financial analysts are projecting that this intervention could slash mortgage rates by anywhere from 0.25% to 0.5%, which translates to roughly 6% more buying power for consumers. In fact, we're already seeing results. The 30-year fixed mortgage rate just hit 5.99%, matching the lowest point we've seen since February of 2023. On the surface, this sounds incredible, right? Lower monthly payments, more affordable housing, everyone wins. But here's the problem. When you inject stimulus into a market that's already suffering from a severe shortage of inventory, you're not helping buyers. You're handing sellers a massive advantage. Cheaper financing doesn't solve scarcity, it just inflates the price tag. Let me explain what I mean by taking you back to the 2005 to 2007 housing bubble. During that era, home builders went absolutely insane. Demand was so strong that they constructed more homes than the market could absorb. People were getting approved for mortgages with zero money down, no income verification, nothing. And when the music stopped, the entire system imploded. Now, normally, a correction like that would be healthy for the market. It's exactly how I was able to buy my first property for a quarter of what it's worth today. But something different happened after 2008. Home construction never recovered to pre-crisis levels. And then 2020 hit, and everything got exponentially worse. During the pandemic, mortgage rates dropped to historic lows. People refinanced into incredibly cheap loans. We're talking 2.5%, 3% interest rates. But once rates started climbing again, homeowners became prisoners of their own mortgages. Why would you sell your house and move when doing so would increase your monthly payment by 50%? So people stayed put. Combine that with the fact that builders still haven't ramped up production to where it was 2 decades ago, and you've created a perfect storm that keeps prices elevated. However, we're starting to see cracks in the foundation. For the first time in years, inventory levels are approaching what we last saw in 2019. At the current trajectory, we might actually enter a buyer's market where supply finally catches up to demand. Here's a shocking statistic. By the end of 2025, home sellers outnumbered home buyers by 530,000, the widest gap we've seen on record dating back to 2013. And a huge piece of this puzzle comes down to affordability, which brings us to our next critical issue. Let's put this in perspective. Back in 2000, the median home price was just $120,000. Which represented about 1.7 times the median household income. Fast forward to 2024, and the median price had skyrocketed to $412,000, nearly 5 times the median income. This is why you're seeing more home buyers over the age of 70 than under 35. The math simply doesn't work for younger generations anymore. In 2026, the ratio of U.S. home prices to median household income sits at 7 times, hovering near an all-time record. That's actually worse than the 2006 housing bubble when it took 6.8 times the median income to afford the typical American home. But there is a silver lining here. If mortgage rates decline from 6.5% down to 5%, nearly 6 million additional people would suddenly qualify for homeownership, assuming prices remain stable. On top of that, there's one affordability metric that almost nobody's discussing, and that's wage growth. According to recent projections, starting next year, incomes are expected to rise faster than home prices for an extended period, the first time that's happened since the Great Recession era. Now, before you get too optimistic, remember this. Even with 6% mortgage rates at current prices, you need to earn around $110,000 per year to afford the median home. That's double what was required back in 2020. And there's another curveball that most people aren't factoring in. Ownership costs like property taxes and insurance are climbing way faster than anyone anticipated. 8% of borrowers now pay more for taxes and insurance than their actual mortgage. So with costs surging, rates dropping, and the math breaking in ways most people aren't talking about, it's essential to understand what experts are forecasting for the next 12 months and why I'm personally exiting the market entirely. Because the reality is far more complex than you probably realize. Let's talk about what this $200 billion injection is actually going to do. Like I mentioned earlier, there's widespread expectation that this will bring down monthly housing costs. And yes, in the short run, buyers will benefit. A reduction of just 0.25 percentage points in mortgage rates boosts purchasing power by roughly 3%. So if rates drop by 50 basis points, a buyer could increase their purchasing power by 6% while keeping the same monthly payment. We've already seen rates tumble by some of their largest amounts in years. But here's where things get tricky. Some experts believe that in the short term, this could actually cause home prices to spike upward as buyers rush to lock in lower interest rates. As one chief economist put it, the resulting surge in buyer demand could apply upward pressure on home prices, offsetting some of the intended affordability relief. In simpler terms, cheaper financing just allows prices to climb until monthly payments reach an equilibrium between supply and demand. And without a significant increase in inventory, the end result will most likely just be moderately higher housing prices. It's also crucial to clarify that this is not an ongoing stimulus program like we saw in 2020. This is a one-time short-term intervention, and because of that, it's unlikely to change builder behavior or meaningfully increase housing production. From my perspective, even though $200 billion sounds massive, let's put it in context. The entire mortgage-backed securities market is currently valued at $11 trillion, and the Federal Reserve still holds $2 trillion of it on its balance sheet. This means a $200 billion injection represents roughly 2% of the Fed's current holdings. Without sustained stimulus over an extended period, the benefit will likely evaporate once the funds are depleted. So what's this going to do to housing prices? Well, according to the latest forecasts, Zillow predicts prices will rise 1.2% nationally in 2026. Fannie Mae anticipates a 1.3% gain this year, and Redfin follows closely with a 1% projection. Additionally, they expect certain markets will perform quite well, including New York suburbs, Cleveland, St. Louis, Minneapolis, and Madison, Wisconsin, while other locations like Nashville, San Antonio, and several Florida markets might continue declining. The most bullish housing forecast comes from Realtor.com, who anticipates a national 2.2% increase in 2026, driven by moderately falling rates, with specific markets seeing some of the steepest declines. Now, it's important to mention that even though every single analyst expects home price growth in 2026, every one of those predictions is actually negative once you factor in inflation. For example, if your home appreciates 2% this year, but inflation runs at 3%, you've effectively lost 1% of purchasing power, even though your home is technically worth more on paper. So the general consensus seems to be that home prices in dollar terms will increase, but their value relative to inflation will decrease. Does that make sense? Now let me explain why I'm personally selling off my entire real estate portfolio. Over the past 2 years, I've taken a hard look at every single property I own, calculated how much they've earned, assessed my equity position, and determined that on a large scale, I'd generate identical returns investing in virtually anything else, but without the risk, without the hassle, and without the headache of managing rentals. For example, one of my properties now has $600,000 in equity that's only generating a 4.5% return. At that yield, it doesn't make nearly as much sense to hold on to it as it did when I first acquired it, and it was delivering a 12% return on equity. Put more simply, property values have appreciated so much that it's no longer a worthwhile return on capital. I know that's a strange problem to have, but that's just the tip of the iceberg. I'm also noticing that my overhead expenses are ballooning to a point where I don't see improvement anytime soon. My insurance premiums have doubled compared to what they cost 5 years ago. My water bill, which I cover, is up 50%. Any kind of repair or maintenance work is 50% to 100% more expensive than when I first purchased these properties. And now, with Los Angeles capping rent increases at 90% of CPI, this essentially guarantees that I'll never keep pace with inflation. Combine that with never-ending California taxes and mortgage rates declining, which should temporarily boost the value of my properties even further, and it's a no-brainer to liquidate everything, move my capital into something else that generates an identical return, and achieve the same results without any exposure to tenants, unexpected overhead, or California government policy. Honestly, this is something I never imagined I'd say. I bought all these properties between 2012 and 2019. I spent months renovating them from dilapidated conditions. They all have 3% mortgages locked in for 30 years. I never raised rents because I simply wanted reliable tenants who would take care of the property and pay on time. I didn't want stress, so I passed the savings along to the tenants. But at this point, they're pushing out people like me. And most likely, whoever replaces me is going to be far worse for the city of Los Angeles. Just saying. Now, in terms of what this housing market means for you, based on what I'm observing as both a seller and someone who's been involved in real estate since 2008, I'm noticing that prices are softening. There's more inventory hitting the market, and for the first time in a long time, buyers are starting to gain leverage. Obviously, every location is different, and some areas could experience significant price increases. But if you're in the market to purchase a home, I'm not going to tell you it's a terrible time to buy. However, it is a reminder to stay within a price range you can genuinely afford. Don't rush into something out of fear that the housing market will outpace your ability to buy. And don't hesitate to negotiate when the opportunity arises. I'm seeing countless listings that have been sitting for months without a single offer. And while a percentage of those sellers are simply testing the waters without any real intention of selling, there are other sellers who went in with the wrong strategy, overpriced their property, and are now chasing the market downward. Those are the people you should be willing to negotiate with. At the end of the day, this isn't me saying you shouldn't buy a house in 2026, or that housing is a bad investment, or that the market's going to crash. But it is saying that the rules for real estate have fundamentally changed. Over the past decade, buying virtually any house in any condition, in any location worked because overhead costs were manageable, prices kept climbing, and patience was rewarded. But now, with higher overhead costs, slower appreciation, elevated mortgage rates, and less margin for error, every single purchase needs to be meticulously scrutinized. It's no longer a no-brainer to buy a house. For me, that means cashing out, simplifying, and reallocating assets into something that delivers better risk-adjusted returns. For you, that might mean scrutinizing every deal, running the numbers, determining whether it's better to rent or buy, and not confusing past performance with future results. I think the biggest mistake people are going to make over the next few years is assuming the old playbook still works. And also not hitting the like button or subscribing to Economy Breakdown if you haven't done that already. Seriously, thank you so much for watching. Drop a comment below. I'll do my best to read and respond to as many as possible. See you in the next one.